In May 2024, employees at dozens of Red Lobster restaurants across America showed up for work, only to find the doors locked, the lights off, and a sign saying the location was permanently closed. No warning, no final paycheck, just gone. Red Lobster, the chain that brought lobster to Middle America, that was once the largest seafood restaurant in the world, had collapsed. But this wasn't just bad luck. This was a heist, executed over 10 years by some of the most sophisticated financial players on Wall Street. This is the story of how private equity destroyed Red Lobster. Red Lobster was founded in 1968 by a man named Bill Darden in Lakeland, Florida. His idea was simple but radical. Take seafood, something most Americans only ate on vacation, and make it affordable for the middle class. Before Red Lobster, if you wanted lobster, you either lived on the coast or you were rich. Darden changed that. The chain exploded. By buying seafood in massive quantities, Red Lobster could offer prices that local restaurants couldn't match. General Mills acquired the chain, and by the 1990s, Red Lobster had become an American institution. Those Cheddar Bay biscuits, iconic. The endless shrimp promotions, a cultural phenomenon. In 1995, General Mills spun off Red Lobster into a new company called Darden Restaurants, named after the founder. Darden also owned Olive Garden, and together they dominated American casual dining. For decades, Red Lobster was profitable, stable, and beloved. Then, in 2014, everything changed. Darden Restaurants decided to sell Red Lobster. The buyer? A private equity firm called Golden Gate Capital. The price? $2.1 billion. Now, if you're not familiar with how private equity works, here's the short version. These firms buy companies using mostly borrowed money, extract as much cash as possible, and then sell what's left, hopefully for a profit. And Golden Gate had a very specific playbook for Red Lobster. Within months of buying the chain, Golden Gate executed what's called a sale-leaseback. Here's how it works. Red Lobster owned the land and buildings where most of its restaurants sat. That real estate was worth a fortune, so Golden Gate sold all of it, the land, the buildings, everything, to a real estate investment trust for $1.5 billion. That's right. They bought Red Lobster for $2.1 billion and immediately got $1.5 billion back by selling assets the company had spent decades accumulating. But here's the catch. Red Lobster still needed those buildings to operate. So now, instead of owning their restaurants, they had to pay rent to the new owners at rates that would only go up over time. Golden Gate had essentially saddled Red Lobster with a massive permanent expense. The bankruptcy filing would later describe these leases as above market, meaning Red Lobster was paying more than the properties were worth. This is the private equity playbook. Buy a company, strip its assets, load it with debt, and let someone else deal with the consequences. In 2016, a new player entered the picture. Thai Union Group. Thai Union is a $4 billion Thai conglomerate. You probably know their brands: Chicken of the Sea Tuna, John West Sardines. They're one of the biggest seafood companies on the planet. Thai Union took a $575 million minority stake in Red Lobster. Then, in 2020, they led an investor group to buy out Golden Gate entirely. On paper, this looked like a rescue. Golden Gate was out, and Red Lobster had a new owner with deep expertise in seafood. But there was a problem. A massive conflict of interest that would eventually destroy the company. Thai Union wasn't just Red Lobster's owner, they were also Red Lobster's supplier. The same company that controlled Red Lobster's decisions was also selling shrimp to Red Lobster at whatever price they wanted. Red Lobster employees were told Thai Union wouldn't interfere in day-to-day operations. Quote, "We intend to maintain relationships with all current seafood suppliers." That promise lasted about 2 years. By 2022, Thai Union executives from Thailand were embedded in Red Lobster's Orlando headquarters, serving in top roles and making major decisions. "We are much deeper involved in the management of Red Lobster," Thai Union's finance chief admitted on an analyst call. What followed was a disaster. Veteran Red Lobster leaders, people who had been with the company for 20, 30, even 40 years, were fired or pushed out. The company went through 5 CEOs in 5 years. Former employees describe a toxic environment. One executive, CEO Paul Kenny, allegedly mocked an employee's weight at a company event. And then there was the feng shui consultant. Thai Union's CEO reportedly brought a feng shui consultant to Red Lobster's headquarters. The consultant determined that the executive offices had bad feng shui and no one should use them. The offices sat empty. But the real damage wasn't spiritual. It was in the supply chain. Under Thai Union's direction, Red Lobster cut 2 of its longtime shrimp suppliers and replaced them with Thai Union's own shrimp at higher prices. The bankruptcy filing would later allege that Thai Union exercised outsized influence on Red Lobster's purchasing decisions. The company is now investigating whether these decisions were made to benefit Thai Union at Red Lobster's expense. In 2023, Red Lobster's CEO made a fateful decision. The ultimate endless shrimp had always been a limited-time promotion, a loss leader to get customers in the door. But Paul Kenny decided to make it permanent, at just $20. According to the bankruptcy filing, this decision came despite significant pushback from other members of the company's management team. Why would a CEO ignore his own team's warnings? The filing suggests Thai Union was pushing for it. More endless shrimp meant more shrimp purchases from Thai Union. The promotion was a hit with customers. Too much of a hit. People came in waves, ordering plate after plate of shrimp. Red Lobster lost $11 million on the promotion alone. But remember, $11 million is nothing compared to the damage already done. The above-market lease payments from the sale-leaseback, the supplier conflicts, the leadership chaos. Endless shrimp was just the final straw. In May 2024, Red Lobster filed for Chapter 11 bankruptcy. The company that had pioneered affordable seafood for Middle America was drowning in debt it never should have had, locked into leases it couldn't afford, and run by owners who seemed more interested in selling shrimp than saving restaurants. The overnight closures, the ones where employees showed up to locked doors, may have violated labor laws. Workers are still fighting for back pay. Thai Union announced plans to exit their investment entirely. Having extracted what they could, they were done. Red Lobster emerged from bankruptcy a few months later, sold to new owners. Some locations have reopened, but the chain that once had over 700 restaurants in its prime is a shadow of what it was. Red Lobster's collapse isn't a story about shrimp. It's a story about what happens when financial engineering replaces actual business operations. Golden Gate Capital bought a profitable company, stripped its assets, and left it burdened with debt. Thai Union bought what was left, installed incompetent leadership, and used the company to boost their own shrimp sales. And American workers, the servers, the cooks, the managers who built Red Lobster over 50 years were the ones who paid the price. That's how private equity works. And Red Lobster won't be the last. If you want to understand how companies really fail, subscribe. We break down the business stories no one else is telling.